Hasham Piperdy, Director at BADRI, who will be sharing his expertise on M&A. Please welcome him on stage.
Thank you, Shruti. Very good morning, everyone. So over the next 20 minutes or so, I'm going to be covering another hot trend at the moment in the GCC market, M&A. There's been a buzz of activity of M&A in the region, and I'm going to start with a bit of a market backdrop, give an overview of the deal activity that's been going on in the region, and then think about, what have been some of the drivers. It's been different considerations in different markets, and then from a deal perspective, what I'm seeing, there's a big disconnect between expectations. So, before you approach a target, thinking about the merger, there's a sharp shift in focus, between, what's important before you enter into the deal and the reality once the deal is done. And some final thoughts for the future. All right. But before I get into this, in terms of the market backdrop, right? So this is not complete. I ran out of space here, and I've put deal activity. So a lot of activity, a lot of deals which haven't actually crossed the finishing line as well. And as you can see, across multiple markets, across the GCC, UAE, KSA, different drivers in different markets. And the average deal value potentially may be understated. Again, I'm not going to go into valuation techniques, but I can only see this trend continuing, and there's different reasons. If I look at it, if I also include, so those were just deals within the region. If I also think of, outbound and inbound business, actually the biggest deal over the last few years is actually an outbound deal. So close to $1 billion. Abu Dhabi Investment Authority invested in a UK insurer. But you can see that the sizable investments are across the market. So what's driving this? I'm going to start with a question for you guys first. Get the feel for the room, right? So just a quick yes or no. Do you think, and bear in mind the market dynamics that were presented earlier, right? The competitiveness in the market. Do you think the region will benefit from some consolidation? Yes or no? So no if you think the market is performing well. Yes, particularly, it can be challenging for small to mid-sized players. Or in between, if I think potentially there may be some strategic or tactical opportunities here and there. Sorry? Okay. So to get onto the survey, it's menti.com, menti.com, and the code is 85906988. Okay. We have a look at the results. Can we see the results? Let's have a look. Okay. Definitely hard to be competitive for smaller players. This is something, a key focus, right? You've got two markets. If you take the largest markets, UAE and Saudi, is it healthy for, do we have a good balance in terms of, competition in the market? Okay, so in terms of the main drivers, now, deals are done, so in my experience from UK, Asia, probably worked on 100 plus different deals in different sectors. But essentially, there's a few key principles that drive drive M&A activity, right? So there's deals where we want to scale up. And you just want to bring those expense ratios down, be able to, focus on near-term growth, so writing similar business, economies of scale. Otherwise, there's tactical plays, fintech, where you're buying high growth opportunities or buying technical expertise, expanding into different areas. So coming back to the GCC, another question for you. What do you think, if you could rank these, what do you think are the main drivers in terms of priority? So I've listed 6 here. There may be others, but capital solvency, scaling up, diversification, market entry, market exit, we've seen a few of those, digitalization, regulatory considerations, or regulatory push. So just rank these in terms of what you think the top drivers are. It'd just be interesting to get your view. Just give you a minute to get some responses for you. Okay, let's have a look. Capital, the top 2, perfect. My presentation covers both of these as the key drivers. Okay, but I think it's pretty clear what's driving it. Capital and solvency, number 1. And scale, diversification, regulatory push. Okay. I would actually agree with you. I would also say perhaps maybe more in Saudi than here, regulatory push as well. So if we think about scaling up, right? So there are obviously clear benefits of economies of scale, but what about hard numbers? What does it actually mean in our markets? So again, I'm going to ask a couple of questions related to the benefits of scaling up, and then I'll share the actual answers afterwards. So if we could move on to the next question. Okay, so think of combined ratio for the... Okay, I think if you hover over the text, it'll show the economies of scale at the top. Yeah, for some reason the text disappears. So think of economies of scale. UAE insurers, what's the gap in combined ratio from the very smallest to the largest insurers? Is it below 10%, 11 to 20, 21 to 30, or over 30%? And this is based on FY22, the last year of numbers under IFRS 4, which I could actually interpret before we move to IFRS 17. The world used to be so much simpler under IFRS 4. You could find the combined ratio on the financials. Okay, so just kidding. Okay, so 11 to 20. Okay, it's quite a mixture of views. So 11 all the way to over 30%. Okay, I'll share the answer with you a bit later. But it's interesting. Okay, and one more question relating to scaling up. So this is across the board in KSA, okay? So focusing on expense ratios, right? So again, what's the difference in expense ratio between the smallest and largest insurers? Below 10, 11 to 20, 21 to 30, over 30. Okay, let's have a look. 11 to 20 is getting... Okay. I'm going to share the answers with you now. interesting, there's a wide range of views. Okay, so are there any benefits? Right. So I'm going to cover expense ratios first and then combined ratios for the two countries, okay? So in terms of expense ratios, starting on the left with the largest companies, you know, the giants in the market, all the way up to the very smallest ones, 22% difference in terms of economies of scale. Obviously, what does that mean for competing in the same product? Huge. In KSA, the difference in expense ratios from the largest to the smallest, 24%. But you can see, even going up to the largest, mid-sized players, huge benefit. Combined ratios, right? From the smallest to the largest in UAE, 39% based on FY22 numbers. Incredible in terms of combined ratio. And even from, you can see the difference between, you know, absolutely really stark, steep line showing economies of scale. Not as dramatic, but it's still there in KSA, combined ratio, so primarily driven by the expense ratio. So here, you know, you can see in both markets, where you've got markets dominated by a handful of small players, you are going to get this sort of disparity. It was good to see, so when I asked, you know, what do you think one of the main drivers is, solvency capital. And you can understand why, the way solvency capital works here. There's quite a few insurers that are below 100% in the UAE at the moment. And there is a bit of an regulatory arbitrage, or however you want to call it, where if you have small insurers, so you've got insurer A, insurer B, it's not based on, this is a theoretical example, but just to illustrate the point. So you can have a situation where you've got two small insurers. One is 80% solvent, another one is 90% solvent, and they come together, and post-deal, you know, their solvency could actually improve to 121%. And that's if you're if you're a small insurer and you're hit by the MCR, the minimum capital requirement. So there is a benefit in terms of, you know, scaling up, and also in terms of solvency capital position, potentially for smaller to mid-sized players to come together, right? Okay, so moving on, I'm going to talk a bit about the disconnect between the focus before the deal is done, what we perhaps should be thinking about post-deal, and then also some examples. I've taken two examples to show these were deals that were done in the GCC, and to show, you know, have the benefits been realized or not, okay? So in terms of pre-deal, what's the focus? You know, I mean, this is a typical M&A playbook for work for a lot of large private equity players. And the key thing here is, in the playbook, by the time you're thinking about sourcing, even pre-deal, before even getting into negotiations on price, you're already thinking ahead to transition issues. What do we actually focus on, based on my experience? So predominantly financial, it's all about the numbers, right? Financial, actuarial due diligence, the biggest item on the balance sheet, the technical reserves, lots of time and effort debating about, you know, are the reserves at the right number, and, you know, the term sheet of adjustments that we actually end up coming up with. Also, there's legal, tax, operational, and some other considerations. But quite often, you know, do we also go into, so in terms of best practice, doing deals in London and other markets, it's not just about a snapshot of the position today, or where we are, what the, you know, underwriting performance over the last 3 years. It's looking at potential, not just the impact on solvency, how, what would the potential strategy be for the new merged entity, increase in reinsurance capacity. There's ERM, there's a whole range of things which are just overlooked. And more importantly, okay, so I'm going to move on to post-acquisition, right? So what actually happens in practice? We have, the deal is done, and then all of a sudden you have to start thinking about how you actually integrate the two entities together. And the number of times where, achieving those synergies is hard, right? Involves looking at people, processes, and systems across the two entities, right? And how do you think about it? Well, there's different extremes depending on the nature of the transaction. Maybe you're absorbing the company on the top left as a whole, right? So you're imposing, your own culture, processes, systems, and so on, and completely integrating. On the other hand, they may be playing in a different market, or and you want to, on the bottom right, you want to keep them as a standalone, self-governing, perhaps run off the business, and all you have to do is get the financials to consolidate. And there's, others in between, right? But what often gets overlooked, so, again, I'm not going to go over this, but this is a real IT integration plan. And especially, the amount of time and effort, for example, we've spent upgrading our core systems or modifying them, investing in IFRS 17 systems. Again, it's very much an afterthought. And culture and the people aspects goes without saying. Quite often overlooked at the pre-deal stage. And what could that lead to? Loss of expertise, leadership at the target, and so on. So, we'll now pose another question. So what do you think, from your perspectives, would some of the biggest challenges post-merger? If you could just rank these. So leadership and management changes, workforce retention, culture, customer experience, IT integration, financial accounting, or legal and regulatory. Okay, let's have a look. Leadership and management changes, absolutely. Key man risk is huge in the region. And leadership and management, and often losing a very good technical underwriter as well, could have a huge impact. IT integration. Okay. Interesting, legal and regulatory challenges right at the bottom of the list. Okay. So now I'm going to, share with you some analysis that we've done. It's very high level, but I think it illustrates a point. So what we've done is we've looked at two transactions that took place in the region and carried out a very simple analysis. So pre-deal standalone, what was the business, and post-merger or post-acquisition, we just looked at three simple metrics. In reality, there's going to be a wide range of KPIs to look at. So we just looked at production, GWP, underwriting profitability overall, and equity, balance sheet equity. So for the first, and I've left the names off, but just want these to be more illustrative, right? But they are based on actual transactions and real data. So first one, merger of two insurers in the region. 2 years after the deal, what actually happened? So looking at Company A, Company B, and post-deal, pre-post-deal. So production actually 2 years after the deal is actually about 15% lower. But if you look at the chart on the right, you can see why, right? So the larger company was actually heavily loss-making, and you can see that this is to a different scale, but underwriting profits have actually tripled, versus the standalone results 2 years after the deal. So it all sounds pretty good so far, right? Not quite that simple. If I'm a shareholder, what's the return I'm actually getting? So just at a very high level, looking at the balance sheet equity before the deal, the two companies, it's quite concerning, right? So balance sheet equity is actually dropped around 15%, which suggests that, it hasn't been a profitable time in the, 2 years since. But one other complication, in between, in the 2 years, they actually had a capital raise. So allowing for that actually reduces this chart, this line would go down even more steeply, reduces that by about 80%. So, was this deal, clearly, in the interim, in the short term, doesn't look like it's been that successful, but it looks like we're on the positive trend. 2 years is too early to say in my book, but you can see that with the rise in underwriting profits, the losses have turned around and things will get there, but how long will it take, right? The second one, again, two insurers in the region. GWP, 2 years after the transaction, is about 40% below what it was pre-deal. Again, similar pattern, very soft market, loss-making for one of the companies. In fact, which was probably one of the drivers for the merger, solvency issues, loss-making. So, on a positive trend in terms of underwriting profits. And what's happened in terms of shareholder equity? For this one, there has been an improvement, right? So, around 25% improvement, compared to the standalone entities, right? And there was a capital raise in between, but even then, you're still getting an 8 to 10% improvement. So these are just two deals. And it would be interesting to do a full analysis looking at all the data on merger market and looking at a wider range of KPIs. But for me, the jury is mixed in terms of time will tell. A lot of good deals have been done in the region in terms of you can clearly see the synergies and the benefits of the deals. But a lot of distressed deals have also been done when companies have been in a difficult solvency position or loss-making position. And even injecting new capital and so on, it looks like things are on an upward trend, but it would just take a bit longer. But, how you structure the deal, how you value the deal, how much you pay up front is critical, of course. But anyway, just thought I'd share those snippets with you. And looking ahead to the future, very optimistic about the region in terms of activity levels. So there's a number of insurance reports prepared by brokers. This was by Clyde & Co., which is giving a similar sentiment and a similar message. So in global M&A, given the economic backdrop, there's actually been a drop in activity, but the Middle East is actually bucking the trend. The level of M&A activity is actually shooting up. And I think, the drivers will continue to be the same ones as before, but with such a concentrated market, where you've got a handful of players dominating both UAE and KSA market, and the regulatory push as well on solvency and stronger balance sheets, I think this trend is certainly going to continue. All right, so with that, I'm going to wrap up. Open to any questions. Thank you.